All right, man. Good evening. You guys are in week two. All right. Please go on mute. Please go on mute unless we asking questions.
There's some heavy breathing going on too. You might want to just mute everybody.
Yeah, I'm about to do that right now. Hold on, give me a second here. All right, where's my mute everybody at? It's not giving me the option. All right, not finding an option. We're just gonna give me 1 second, man. I'm just gonna stop the recording real quick and start over. Man, this Zoom is killing me. All right, Zoom needs a mute all option when you're in presenter mode. That was too much work. All right, let me get back started here. Share the screen. Current slide. Make sure we're still recording. All right, cool. Here we go. Oh man, you guys are in week two of the new Wall Street stock market course. Give yourself a pat on the back for coming back for another round of this. We're going to get into some real fun stuff today, talking about the fundamentals analysis of a company and what makes it a good stock to buy. But let's do a quick recap. Last week, we talked about the history of the stock market. We talked about how it works. We went over a lot of the jargon, the different terms and definitions of things, the 6 types of investments, why we should invest, what do we invest in, and of course, we left off where do we even start? And so when we did the where do we even start, I know some of the homework questions, people were asking, hey, what should we do as far as homework? And Mike had a great idea and said, start with downloading some of the applications that we mentioned last week, like TD Ameritrade, Robinhood, and Webull, and start messing around with those so you can get familiar with them. Now, I understand a lot of these apps, when you open up, there's a lot going on. So it's like, what am I even reading here? How do I make heads or tails of what's going on within these apps? So I want to start there and kind of talk about that a little bit. So a couple of things that you see within the app, you're going to see your ticker symbol, and all that is the alphabetic name that they use. So like for Amazon, instead of the full name, it'll be AMZN. So the abbreviated name, that's your ticker symbol. That's what that means when you see that. Of course, the price is going to be the current price at any given time of the stock that you see within the app. The open, when you see is say open, that means what price did the stock actually open at for the day, and then close is right when the market's closing, and sometimes even after hours, what is that last price that you see from the previous day when the market closes out. Your days range is giving you the low and the high. So let's say in the morning, a stock opens up. We'll talk about the SPY, the S&P 500 this morning, opened up at 415. In the day, it closed out at 421. So that day's range is about $6 in the range that it had for the day. So that's just the low and the high. You'll see your 52-week low and high, which is basically just the trailing year of the price's highest and the price's lowest. And those are all very important, and we'll talk about why a little later. Then the trading volume, which is your total shares traded for the day. This is important because you don't want to buy a stock just off of hype if there's nobody on the other side that you can sell it to, because that's how you get caught holding the bag. So you want to make sure that anything that you purchase has a good amount of trading volume that's going to be associated with it, so you can make sure that you can always get out of your trades and sell. 1 second here, I was looking. I want to see something real quick just to make sure. All right, cool. And then the candlesticks, Japanese candlesticks, those little green and red things that you see with wicks all over the place, those are your candlesticks that just show, again, that kind of goes back and just shows the range of a stock's price throughout the day, the opens, the highs, the lows, and all those things within a specific time frame. So let's give you a visual real quick and of what I'm actually talking about. So reading the stock chart, this is Robinhood. Again, it's not my favorite app, but it's a very user-friendly. So we'll just go ahead and start with Robinhood. This is what most people like to start out with just because of its mobility and its ease of use. So when we talked about the ticker symbol, again, when you look up a stock, Amazon, the ticker symbol is what you're going to be seeing here. These are your Japanese candlesticks, like again, the charts that you actually read. And this is a part of technical analysis that we'll talk about a little later. Your total shares traded will be down here. And that's, again, total shares traded or today's volume. You want to make sure that stocks have high volume when you're trading. So again, you can make sure that you sell those out. You can see your percent change of a price during a certain trading window. And then when we mean by trading window, it means the view that you're looking at. Are you looking at a 15-minute chart? Are you looking at a daily or a weekly chart or a year or 5-year chart? It was asked last week, like, what time frame do I like to look at for a stock? And typically when it's a long-term portfolio hold, I want to look at the 5-year to see how a stock's actually doing over the last 5 years of time. Now, we got through that, but I don't want you to start buying anything quite yet if you haven't already, because before you buy a stock, you want to understand what your sentiment about a stock is going to be. And there's 2 types of traders that are out there and 2 types of sentiments. You're either going to be a bull or a bear when it comes to this stock market. In a bull, you may hear somebody say, man, I'm very bullish on Tesla. That means that I believe that Tesla is going to continue to go up. So I'm taking the stance that I believe that this stock is going to continue to rise. So I'm bullish on it, the horns of the bull. Bearish is like, hey, I think this thing is going to crater and crumble. So I'm either going to wait for this to draw back to where I find a better entry point before I get into it, or once we talk about stocks options, I'm gonna go short or put in a put option on this and make money as the price goes down. So 2 different types of traders that are out there, or people that purchase stocks. They're either bullish or they're bearish. Now, to understand and get to that, sentiment, you have to do 2 things. There's 2 ways to do that. You have your fundamental analysis and you have your technical analysis. And this week, we're talking about fundamental analysis and how to actually analyze a business to see if a business is a strong business that you want to be investing in. And the fundamental analysis is pretty much that. It's the foundational things about a business that we should be looking at. Is it making money? What are the earnings looking like? What are their assets and liabilities? Just like if you wanted to go date somebody, do they have an income? Do they have a job? Do they have too much debt? We want to look at stocks in the same way, because when you do a long-term portfolio, you're marrying yourself to this stock for a couple of years. So one of the most important things that you start with is the industry and market analysis. So industry trends are huge. So think about the banking industry right now. This is the one that's most prevalent. You have your regional banks that people are being terrified on because we've seen a couple of them crash. So people are withdrawing their money and slowing up their deposits into regional banks and taking them to the larger banks like your Chases and your JP Morgans. So the industry trend right now is that regional banks or a little shaky. So their stocks aren't doing that great because people are pulling money out. When people pull money out, they're not, lending or taking out anything that the bank's earning interest on. So that's going to affect their bottom line when they announce their revenue announce their earnings for the next quarter. So these banks are maybe right now you want to stay away from. So that's an example of an industry trend. And then the competition. Anything that you're looking at, how is it ranked against everyone else in this industry? You don't want the bottom of the bucket. You want the people that are in the top 3 to 4 to 5, as long as they're still a strong company, they're showing year-over-year revenue growth, and they're within your range of affordability. And then lastly is the market size. Are you investing in a company that has a large enough total addressable market to where it's going to continue to grow? You don't want a company that's just so niche that it's going to cap out on you, right? You want something that you can get money on pretty much for the rest of your life and then leave that in a fund or something for the people that come behind you. So we want to look at the market size and total addressable market also when we're analyzing the company. Pause there. Any questions on industry, market analysis, and how to go about that?
No questions in the chat.
Cool. All right. The next piece of information that you want to look at when you're evaluating a stock are the financial statements, right? The income statement. Does this company make income? Is it making money? Okay, that's number one. But then on the other side, what does the balance sheet look like? You could be a company that's making money, but if your outgoing expenses are more than what you're making, you're going to be in the negative at the end of the year. So you want to look at this to see, is this company well balanced? And is the income more than what's going out? And if it's not, what is the reason for it? And if the reason makes sense, I get it. A lot of times with startup companies that are burning through capital for market acquisition, customer acquisition and market reach. So it may make sense, right? For a long time, companies like Uber and Tesla were actually not even profitable because they were churning through so much money, but they ended up to be pretty solid companies in the long run. So if it makes sense, it's okay. But if it's out of whack and it doesn't make sense, that's a company you want to stay away from. The next thing is the cash flow. And cash flow, to put it in terms of like an individual, this is the streams of income. Does this company have multiple streams of income? One thing we don't want to do is get tied to a one-trick pony. We want a company that has all kinds of different products, all kinds of different services and ways that they're earning money. So if anything in the economy affects one, it doesn't affect the entire company. Think about airlines, right? When COVID hit, nobody was traveling. That's the only way that they make money. So airlines got hit pretty bad. We want to stay away from companies that only have one way of making money. Unless, again, unless it's something, so the airline example was a good example because it was one thing that happened and it shut them down, but we also know that airlines are necessary for when the world is moving. So that was actually a great time to find strong airlines that historically have done well at great prices. But still, it is one of those companies or one of those industries where one thing can knock out all the ways that they make money. Revenue growth, right? We want to make sure that companies are actually making revenue year over year. We don't want anything that's stagnant. It's just like anything else, right? We expect to get raises on our job and our next job to be paying us more than the last job. Same with these companies that we invest in. We want them to be having revenue growth year over year because that's what's going to increase the stock price. And that's what we care about. Stock price and the increase in dividend yields are the things that we want to look at. Cash on hand is another thing that's super important because when you have cash on hand, just like with us, when we have cash on hand, we can buy companies at discounted prices. When companies have cash on hand, they can do things like growth by acquisition, right? I'm going to buy another company instead of trying to figure out healthcare myself. Like Amazon, I'm just going to buy this RX company and now I'm in the healthcare space because I had cash on hand. So that's also important when we're looking at companies because they can, have acquisitions. They can, beat out the competition, right? They can stomp out a startup at any given moment because they have more cash available. And the last one is the debt levels. We want to make sure the company isn't too burdened with debt because if debt ever gets called and they don't have anything to cover, it's going to crumble the company. I put PACW right here. They're a regional bank. And last week, they announced that their deposits dropped by 9%, and that when it comes to the deposits that were unsecured, which means there was a lot of money or people that had money in the account that had more than 250K, which is the FDIC level of being secured for anything that happens, they had $12 billion in unsecured investments and deposits in their bank. But the good thing is that they had the cash on hand, $15 billion, so they can cover that debt level if anything happens. So that's the type of things that you want to look for. So a lot of people were scared saying, hey, I'm going to sell these shares. I went in and said, okay, this is a company that went from $30 to $4 because of the banking collapse. They have the cash to cover the debt if anything catastrophic really happens. So I'm not too concerned. Once that information starts coming out and people start feeling a little safer, then this stock is going to get right back to where it was. Enable closed caption. Okay. So any questions on those things there?
Where do you go to view the financial statements?
Good question. So we're going to talk about that a little later, but one of the easiest places is to go to like a Yahoo Finance, right? Go to Yahoo Finance and you can pull up, when you go to Yahoo Finance, it'll show overview, it'll say financials, it'll show history, and you just click on either one of those and it kind of gets you back to what you want to see.
And how often does that report come out?
So the earnings are every quarter. So every quarter companies are required by law to do earnings reports. So each quarter. Key financial ratio. So this is also important. So one of the biggest ones is price to earnings. And what this shows you is this stock overpriced, right? Are they earning enough to justify what they're priced at? Or are people just way too excited about a stock that's going to fizzle out, right? We think about GameStop, we think about AMC, they weren't even making any money. So for them to be priced at $80 and $150 made 0 sense, nothing but a pump and dump, people just buying into the hype because it made no sense because they weren't earning anything. When you look at things like price to earnings ratios, you want to have a company that's about 20 to 25x of their earnings. That's a safe zone. When it gets to 40, 50, 60x, I'm going to start backing up a little bit and digging under the covers to make sure this makes sense. An example is like a Tesla. They're pretty high, but it does make sense because while they are in the EV space, they're doing a ton more, right? They're also a technology company, right? With all the software and automation and everything that runs their cars. So the reason why the sentiment is so high about that is because at any given time, they can start selling their services or their technology or their software to other car companies that will never catch up to them anyway and have another stream of income. So people know that is more than a car company, but for anything else that's way too high, I would stay away from it. The price to book is the price above any assets that a company has. And when you look at this is another one that you want to pair with price to earnings and say, hold on, somebody's coming in late, with price to earnings, and under 1 is typically pretty safe. It actually shows that a company may be undervalued. So if you ever see a company with a price to book ratio of 1 or below, you may want to look at it and see what's going on there because you could be buying a company at a great price. Anything above 3, which is typically the benchmark, is pretty high. Actually above 2 is pretty high, but once it gets to 3 or 4 or something like that, and then they have a price to earnings ratio that's above 25, if you believe in the company, cool, wait till those things come down, and then you know that you're getting that same strong company, but at a better price. And then the other piece on the key financial ratios are the dividend yield, right? You want to make sure that your company's paying some dividend, because if a company can afford to pay a dividend, that means that they're earning money, right? And they're doing well. And dividend is basically a thank you for holding shares in my company. We're going to repay you because we're doing good. We want to make sure our shareholders are happy. So that's why companies pay out dividends. So you also want to look at that too. But like we talked about last week, we don't want to chase the highest dividend yield, because that doesn't always equal a great company. You may have a company paying an 8% dividend, but they're losing 20% year over year. Just doesn't balance out. It's not worth it. You want to have some dividend. Yeah.
There is a question in the chat. So is it safe to say to stay away from new companies unless backed by a successful company, because new companies' financial statements don't show huge profits in the first 5 years?
Man, that's a great question. I say it's a little bit of yes and no. It depends on what type of a company it is, right? So think about, okay, let's talk about Rivian. Right? Everybody was hype about Rivian. They're going to be the Tesla killer. Of course, the first 5 years, they're not doing much of anything. So until a company like that shows and proves at least a profit in 1 quarter, I would stay away from it. But then you also have other new companies that are like in the biotech space that may have been the first to get a new patent on something by the FDA, and they have an advantage because patents hold for 5 to 7 years. So they got 5 to 7 years to get all the money that they want in the space. So that may be a company that makes sense, even though that they're new. That help?
She said, okay.
Okay, cool. All right. All right, competitive advantage. This is key too, right? Got to have a competitive advantage. This goes back to the rank. Where are they ranked amongst their peers? So think about the competitive advantage, things like brand recognition, right? Kleenex is such a brand recognized name that everything's a Kleenex, even if it's a different brand. Google's the same way. It's an action verb now. When somebody wants to know something, they say, I don't know, man, go Google it, right? They don't even say go search for it or Bing it or whatever. They say go Google it. It's turned into an action verb because the brand recognition for what it does is so incredible. And then Coke, I mean, even till this day, across the South, people call every single soda a Coke. That's how strong the brand name is. So when you have a company that has that type of brand recognition, that's a good place to start doing a little more research to see how they perform over the past couple of years and how their trajectory looks to see if that's going to be a company that you want to invest in for long term. Patents, we just talked about that. Examples like an Eli Lilly, right? Get ahead of the game with a certain drug. I think their latest one was something around Alzheimer's. Well, they got that patent for 5 years. Nobody else can do anything with that for the next 5 years, so they can gobble up all the market share that they want before generic brands come out. Cost advantages are also big. When you think about like AWS, which is Amazon's cloud, Amazon Web Services, and Walmart, they're so big and they have so many customers that their economies of scale are almost unmatched. So like a Walmart can buy as many products as they need to make sure that they have the lowest price in the game. And it kind of, is unfair a lot of times. That's why you see when Walmart's come to small towns, the Casey's and Dollar Generals go out of business because they can't compete on the price standpoint. So the cost advantage is good there. And then partnerships, right? When companies have great partnerships that continue to drive them forward, you want to look at that. One huge partnership that everyone's heard of is ChatGPT. Well, Microsoft did a great job getting in front of that from the jump, saying we want to incorporate this into all of our products. We're going to put $10 billion into OpenAI to continue to build out this product. So that just put them back in the cool kids box, right? So partnerships are also super key when it comes to looking at a stock, and that's part of the competitive advantage. All right, so we talked about that. Now let's look at some things. Let's do some interactive exercises. So this is XYZ company's earnings statement. So this is what you see when you look at a company's earnings, right? So you're looking at their revenue, you see their net income, their diluted earnings per share, their net profit margin, operating income, net income in cash, and then cost of revenue. So we're looking at this company and we see, right, all these numbers here under March, and then on the year over year, we see some red, we see some green. So I'm gonna ask somebody to take a stab at this. If we're looking at this company and we're looking at these numbers, would you say this is a company that I would invest in? Who's gonna be the brave soul?
We got yeses and nos in the chat.
Okay.
I don't know.
Okay. Let's go with a yes first. Somebody come off who said yes, and let's kind of talk through why you say yes. And then somebody who said no, we'll pull you off next and understand why you said no. And then we'll break it down.
Bunch of
All right,
nos.
Chris.
I'm gonna say
Um,
no because it ain't no cash on hand, and I don't know what the hell they doing. So
Okay.
I
Okay.
wouldn't know.
No cash on hand. Okay. That's a no. All right. Who's
So
on?
I got a question.
All right.
Why is it that they have net change in cash of 5.15 billion, which is up 154%, but no cash on hand? So that was all the cash that was raised spent?
Good question. Yeah, it could have been that the cash that was raised was actually spent, and it could have been spent on something that's going to make this company a better company. So where are my yeses?
Yeah, I'm gonna say no.
You're going to say no. Okay.
I'm gonna say no.
where are my yeses at?
I was a yes,
Okay. Why were you a yes?
because I like the net change in the cash, how it's going up, even though the year to year look like it's going down. I think it could probably go up later.
Got it. Okay, cool. Let's break it down, and then I'll tell you what company this is. All right. So first of all, it's a company that makes $94 billion in revenue every single quarter. Even though it's down 2.5%, The broader market is down more than that. So this is still a strong company and they're making a ton of money. Number two, the net income, which is the income after all of its expenses, is 24 billion, which means that after it pays out everybody and pays for this cost of doing business, it still's netting out $24 billion in profit, even though it's down 3.4% for this quarter, right? Diluted earnings per share, that means for every share out there, and this can have billions of shares floating, it's making $1.52 per share. Still strong. You see the share price didn't change at all, which means that even though they're making less revenue this quarter, even though that their operating income has gone up, they're still making the same amount of money per share. So they're doing something right here when it comes to the management of the operations. Then the operating income went down, so it cost them less to actually operate. So again, they're doing something right when it comes to that. Net cash and net change in cash, an extra $5.1 billion. They're doing something right. Can't really knock that. And then the cost of revenue, which means how much does it cost this company to actually sell their services and make a profit? $52.8 billion, even, which is also down 3.4%. So they're doing something right on the operational side of things to balance out for the smaller revenue. Now, for all the people who said no, this is Apple. This is the #1 company in the world that you said you wouldn't invest in.
Well, I already got shares of Apple, so I might be okay.
Yeah. So yeah, this is the #1 company in the world. So these are the things that we want to look at, and that's how we got to think about it. Is like, yeah, we see some red, but the bigger picture is telling me they know what they're doing because they shifted around, operations and increased operational efficiencies to make up for the revenue shortfall, to keep their net income the same and also keep their earnings per share the same, plus increase their cash by $5.1 billion. Any questions?
So what number, when you looking at kind of their earnings, is the, like, a percentage wise, should we be like concerned about? Like, is it like 10%, 15%?
So it goes back to taking in consideration everything that we've talked about to this point, right? Let's say it's 10%, but this was COVID. Okay, that makes sense, right? The broader market was down 30%. So a company that's down only 10%, still pretty good.
Okay.
Right. So you still got to take into consideration those other things, like what is the broader market doing? What is their industry doing? Right. And what's going on there first. And then I'll say, okay, all things considered, this is still good.
Gotcha. Are you going to show us kind of the reverse as far as what, like, a company that's doing bad, so we can kind of see those numbers? And
Steal my thunder, ain't you? Absolutely.
okay.
All right. This is XYZ company #2. So we're going to look at this one. No, there's 3 of these. So I'm not saying if this is a good company or a bad company yet, but there's 3 of these, but one of these is going to be an inverse. So let's look at this. Revenue, 988.6 million. They're down 6.9% year over year. Net income, negative 328 million, but they're up, 8.6%. Diluted earnings per share is negative 21. Net profit, negative 33%. Operating income is a negative 365 million. Net change in cash is 154 million. That's okay. And then cost of revenue is 439 million. So looking at this company, yes or no? Don't get scared now. This is a learning environment. Really? Mike, anything in chat? Anybody saying yes or no?
Getting some no's. I plead the 5th.
All right. I plead the 5th. I want you to come off mute. Let's talk through it. Because I want to make sure that you guys get this leaving. This isn't to put you on blast or anything like that, but let's talk through it. Make sure you're comfortable.
not supposed to talk about it if I plead the fifth, but let's go.
Let's go. Let's go. All right. So why do you plead the fifth? Let's talk through it, because this is probably gonna help someone else too.
Because I really, well, it looked like they're on the increasing trend on their net income, and their cost of revenue. Their cost of revenue is going up, but their net income is also increasing as well. So I don't know. I really have mixed feelings on this one.
Okay. No, that's good.
Because their revenue is trending down, but I mean, there's some positives there, but I would honestly not know what to do with this one.
Got it. Okay. Let me help you guys out on this one. Unequivocally, without a doubt, this would be a stock that I would stay away from. Let's talk about why. Yeah, the revenue is going down, but so is the other one. So that's not really the big deal there. But net income of negative 323 million, that's every quarter that they're losing that. You know what I'm saying? So every quarter they're losing 328 million. That's hemorrhaging money. Their earnings per share, that means for every share out there, they're actually losing. So if I own a share, that means I'm losing 21 cents for every share that I own within this company. So that makes no sense for me either. Their net profit margin, negative 33%, right? So that means no profit that they're making. This is just a poorly run company, or it's just a bad idea. Again, we talked about like those one-trick ponies. This may be a company that started out hot, but they just didn't know how to sustain it, and now it's just dying off. So this would be one that I would stay away from for those reasons. Again, net income, I gotta see you making something, right? If you talking to a dude and he like, man, every quarter I'm in debt $30,000, you're gonna be like, man, ain't no way, right? There's no way, bro. Keep it moving. And then the profit margin piece, like there's not, I can't deal with that. I need a company that is sustainable, that's making money, and that's growing. That's what we want to look for. If it's not doing those things, you got to get out of here.
I have a question.
Okay.
So when we're looking at the net income and it's going up, it says 8.61%. Does that mean the debt is going up, or is the debt going down?
No, price of the debt going down. That means they're making more net income, but it's still negative, right? So it's like, okay, we went from maybe 340 negative to 328 negative. They're trending in the right direction, but it's going to take a miracle for this company to come out of a quarterly deficit of 328 million every quarter, right? They're going to have to do something miraculous in order to come out of this and start being a profitable company quarter over quarter. But yeah, you're looking at it right. That's definitely what that means. It means that, you know, their earnings are going up. But yeah, that's too much. Now it feels like negative, I don't know, 5 million this quarter. We can look and do some more digging to see why, right? But that's a big hurdle to overcome. Good questions. Anything else, Mike?
No, that's it. We got a statement. Spice said they'll run puts on this.
Hey, 100%. This is, yeah, do a lead put, let it die. All right. So now let's look at this. So this is XYZ company.
So wait, I got a question about the last slide real quick. I couldn't get off mute. Where this company, I'm thinking about if you compare it to a, what was the COVID company that made all the money with the vaccine?
Pfizer?
No, not Pfizer, the new one.
Moderna?
I own it too. What's the name of that damn company?
Was it Moderna?
Moderna.
Yeah.
If you could, if you're early stage of a Moderna before COVID, they may have had numbers similar to this. COVID happens, a lot of people made money off Moderna versus somebody else that's something like a Bed Bath & Beyond or a Party City that's later in their company life cycle, that's on their last.
Right. So with that's a great example, because with Moderna, again, they go back to a competitive advantage, right? They are a medical company, right? Biotech. So if they get the right patent, they're going to have a huge competitive advantage for a couple of 5 years or something, right? So that would be one that would be a little different, but it also will still be a lotto, right? Which is like, this is a lottery ticket still, because if they never get a patent, they could fizzle out. This is Snapchat, this stock right here. So completely different story. But yeah, that's definitely a good point there. It depends on the industry also.
Question, can you bet against a stock, meaning you think this stock is going to plummet?
Can you bet against one? Absolutely. Yeah. So that's called a put or going short. So yeah, if you think a stock's going to die off, yeah, you do a put play and you can make money when the stock goes down. That'll be more week 3, week 4. Then when we talk about that and get into technical analysis, but yeah, we're going to get to that also on how you can make money going up or down. So when we went back to talking about bulls versus bears, betting against a stock is being bearish. All right, so we talked about, I think last week someone asked like, what time frame do you like to look at on a stock? And for me, it's usually the five year, right? Because it tells you a lot about a company. And so this is a company, look how the stock's moving, right? We was putting along here, saw this crazy spike for some reason. I think this may have been around lockdowns and everything, but then we start seeing it plummet. So if I look at a stock and say, man, is this a good investment because the stock is down so much, right? From its high of $80, now it's down to 20, man. What if it goes back, I can make 4X? That's what a lot of people think about. But for me, I'm gonna say, well, if I go back 5 years, whatever this here, I need to see why it did this, because if it never did this, we'd have been sitting right here for 5 years. So now I'm just loaning this company money and not making anything over 5 years. So I'd have to see why this occurred for me to say, yeah, I'll take a risk on that. Because again, over the last 5 years, I would have lost 9% on this stock, about 2% every single year, even with this spike. So if this didn't happen, we're looking way worse, right, over the last 5 years. So this is the first thing that I'll look at and say, okay, what's going on here? If this wasn't here, this is just going to be a flat or negative stock. If this makes sense, and let's say this is something that happens every other year, maybe I'll wait till that next time for this to happen. Or if this was like a quarterly thing and over Christmas, this stock goes crazy. There's a stock that we watch called U1. It's a urban radio station. And every year around Juneteenth, the stock goes crazy, right? Because everybody's advertising. We know that they're going to have a great quarter after Juneteenth. So there's a spike like this that happens. But it's not a long-term hold for me. I get in it around this time. I ride it through about June 17th, and then I sell off and get out of it because I know what it's going to do year over year. Questions on that? All right, cool. Now, this is XYZ company number 2's 5-year chart, and this is what I like to see. I like to see a company that's going up and to the right, right? This is almost a continuous uptrend on this company. There's a little bit of dip here, but look, it recovered very well. And then if I go here and see over the last 5 years, this company has returned 228% over the last 5 years. So about 25% per year that it's been returning historically for the last 5 years. This is what I like to see in the company. Then I'll still go do a little bit of research. What does this company do? Who is this company? How are they ranked? What's their competitive advantage? I'm going to go right back through my entire list, right? How are they within their industry? What is their cash on hand? What is their revenue growth year over year? I'm going to go through my entire list, but this is what I will start looking at. And then I'm going to say, okay, this is a company I want to be in. And you may have guessed it, this is actually Apple. 25% returns year over year. And if we go back max historically, it's about 40% returns for Apple year over year. Again, remember week 1, we talked about the rule of 72. Investing in Apple, you're doubling your money every 3 years. So whatever your net worth is, that you're putting inside of Apple, is going to double every 3 years because of how high the returns of Apple have been for, forever. Any questions or thoughts?
Yes, I have a question. Okay, so on the first example that you gave us, with the numbers, where the example was Apple, and and a lot of people was like, no, or whatever.
Yep.
Yeah, this one. Okay, but right here, it doesn't have cash on hand, right? So I remember you saying that that's, something that we need to judge off of, but that was one of the reasons I picked no. So is it like, I guess I answered my own question. It's not like cash on hand is just a percentage of what matters. That's my question.
Yeah. So all things are considered.
Right. What percentage does it play in the pie as it relates to cash on hand? Does it matter in relation to, say, the revenue, net income, and the share?
So I would say on this one, I'm not sure why they don't show the cash on hand, because they definitely have a war chest of cash on hand. So I'm not sure why it's not shown here, because it obviously has a net change in cash of 5.15 billion. So they do have cash on hand. But when it comes to what percentage does it weigh, yeah, it's important for sure. You want to make sure that a company does have cash on hand. But if you see their revenue year over year that does well, and they're still paying out dividends, and they're still earnings per share, and their net profit is still solid, 25% is a solid net profit, especially for a company that's making $94 billion, right? Margins are usually slim in most instances. So all of those things really go into consideration. I don't know if I can say there's a percentage across the board of what to look for and why, you would say, but I just look across the board at everything. But for me, really, if it's ranked high against its competitors, right? We know this is the #1 company. If they have a ton of revenue streams, which we know that they do, if they're continually growing, which we know that they are, that's good for me.
Okay, that's good for me too. Sure.
Yeah, and then cash on hand is definitely icing on the cake, but of course we know Apple does have cash on hand. All right, company #3. So this one is a little mixed, right? We got some up, we got some down, similar to the last one, right? But the last one we had up and just completely down. Little bit the same here, but we're kind of turning, the corner like it's going to go back up. But then again, I'm going back up here to the 5 years, 49% over the last 5 years, about 10% return year over year. That's solid to me, right? But if before I make a decision, I'm still going to look and say, okay, how does that compare to others within this field, within this industry? I'm going to go and look at their earnings statements and see how they do quarter over quarter, and still go back through my checklist. But 10% year over year for the last 5 years is strong, because there's not a lot of companies doing that. This would be one that I would say, yeah, I'm going to purchase this company and hold for the long term, because this makes sense. Hold on, somebody else is entering the room. So that would make sense to me on this company also. And this is Amazon, right? So I think we know why it's looking like this, right? Remember, we went back to the first one, and I said, I have to know why this happened here for me to make sense of purchasing this company. This is Snap. I don't know why that happened, right? But I know it's dying. This is Amazon. I know why this happened. This is COVID, right? So Amazon was already doing well. See, it was already uptrending. COVID happened and it went crazy, gangbusters. Everybody was locked in. So I know why this happened. Now we're just kind of retracing a little bit, getting back to normal, but Amazon's still going to be a company that's going to grow. So if I can make sense of the middle part of a stock in their chart, and I go back and look at everything else in my checklist, that gives me my level of comfort to say, yes, this is going to be a good long-term play for me. All right. So a couple of other things here is, okay, all right, I'm looking at all this type of stuff, but when does it make sense for me to actually buy this company or buy this stock? There's a few things. I'm going to give you the 2 most simple ones that I like to look at. #1 is the relative strength index, which means how strong is this company long-term? It usually stays within the range of like 30 to 70. 70, you want to look to sell, because that means that a stock is over purchased or overpriced and just running too hot. And that's typically when institutions start dumping their shares. If it's under 30, you want to look to buy. 30, right at 30, right below 30 means that a stock is oversold. So you want to start looking at is when people are fearful, thinking something's going to happen. Stocks probably at a pretty low point comparative, so want to start purchasing in there. But again, it still has to be a strong company. I'm talking about my Googles, my Amazons, my Apples, my Microsofts, my Nvidias, companies like that. I want to look and see when those companies could get to those 30 and below. That's when I'm snatching shares up. If it's a trash company, it doesn't matter. The RSI could be 10. I'm still going to stay away from it. The other one is the moving average, which is like the average price of a stock at any given time. And most often than not, they stay within that moving average. And if they either drop below or go crazy above, they'll come back to those moving averages. So you want to look for that too, right? If I see a stock go below their 200-day moving average, which is the strongest indicator of how a stock's going to move, and it's one of my strong companies, if it's below its 200-day moving average, I'm going to look to start purchasing shares on that. If it's above or high above, I'm going to wait until it retraces back down a little bit for me before I purchase that share. I don't want to buy at the top. I want to buy on sale. I still shop at Ross and Marshalls. I want everything on sale and on clearance.
So, Chris, can you break down what in a moving average actually is averaging?
Yeah, it's just going across. So if it's 20 days, it's the price, the average price of that stock over the last 20 days. If it's the 50-day, it's the average price of that stock over the last 50 days, and the same with the 200-day moving average. It's just the average price of a stock at any given time averaged out over whatever period that you set that to. And cool place to go look at the RSI of a stock is stockcharts.com. It's free. You can just go look and type in your stock name, and it'll bring up the chart and show you the moving averages down here. And it'll also show you the RSI here at the top.
Another quick question. Are you talking simple or exponential?
I use simple.
I use exponential.
So yeah, different type of trading styles.
Mm-hmm.
So either one works though. Yep, either one works though. It just really depends on your trading style. But yeah, I'm a simple moving average guy.
Do you use Fibonacci at all? We'll get some good questions now.
You know what?
Fibs.
Me personally, I do not use the Fibonacci at all. I like my chart clean. I like to see everything very clearly on my chart. I'm at a point where I can eyeball it. And what I realize is that when I do my support and my resistance and my different areas of confluence and my key levels, they line up with the Fibonacci anyway. So I personally don't use the Fibonacci. And to be honest with you, when you look at all of those tools, every one of those tools all have about a 60 to 65% win rate when you're doing day trading. Good question, though. That's somebody that wants to get real technical with their trading. But yeah, people love the Fibonacci. I get it. I don't. I use averages. I use my support and resistance. I use supply and demand zones, and that's what I trade on because I like to see everything happening clearly. What about you, Mike?
Me, yeah, no, I'm not a fib guy. It takes too much to draw out. Like Chris said, I like to see a clean move, supply and demand, support and resistance. And that's basically predicting and anticipating where the price levels and the price action is going. So a lot of these indicators are lagging indicators.
Yep.
So by the time that the indicator is picking up the indication, it's too late. So we try to be more predictive in anticipating where things are going instead of where things are at. So supply and demand lends itself for that. So.
Yep. All right, when to buy and sell continued. There's a lot of triggers or catalysts is what they call it in the market that can tell you when you should start looking at a stock to either buy or sell. One are like buybacks, right? A lot of companies over the last earnings were saying, hey, we're going to start buying back shares of our own stock, which means that there's going to be less supply out there. So when there's less supply out there, but it's a strong company and the demand is outweighing the supply, that's going to drive the price up. So we've seen that happen a lot over the last quarter. Mergers, if they make sense, if one company's buying another company and it makes sense that it's going to help that company grow, like we've seen JP Morgan start buying a lot of these regional banks on pennies on the dollar, which is going to make JP Morgan bigger, then we know that the JP Morgan is going to do well. So those type of things, government regulations, when electric vehicles first came out and the government was giving individuals $7,500 credits for buying EVs, that increased sales. So we knew companies like Tesla were going to do well because it started increasing the sales of those things. Your earnings, if they're good, prices typically go up. If they're bad, prices are going to drop. So you want to look at those earnings reports that we went over already today, good and bad press. I'm going to say Tesla again. A couple years ago, anytime a Tesla caught on fire, the stock would tank. Anytime Elon Musk said something crazy on Twitter, the stock would tank. So good and bad press actually moves the market and moves stocks also. Analysts do things after they do their evaluation of a company to say, hey, I'm either going to upgrade this company because I like what they're doing, I like their forward guidance, or I'm going to downgrade this company, which means I don't think this company is going to perform well in the future. So instead of me having a stock target of $100 in 6 months, I'm going to take that down to $75 in 6 months because I don't really believe that this company is going to grow much. Those things make sense also. So if an analyst is saying, I don't think this stock is going to go to $100 or go above $75 and the stock is right now at $73, I'm not going to buy it. I'm going to wait till that news hits and it causes the stock to tumble to $65 and then start thinking about purchasing and ride it back up to that 70 to 73 and take my profit. New product lines are always huge, right? Anytime Apple announces a new product or a new phone or a new features to the phone, the price starts to go up. So those type of things make sense also. Meme stocks, I hate them. Sometimes though, if you got Wall Street bets with 1 million people going behind the stock to pump it up, you can make a little quick cash there. But if you don't really know how to read charts and price action, I would say stay away, because with that is all based upon hype and energy and emotion. And a lot of times people don't know when to get out. That's why so many people got burned by like Bed Bath & Beyond, AMC, and GameStop. So that's last on my list when it comes to anything is a meme stock or a meme token in the crypto market. Only thing for me when I see meme stocks, I'm going to put action. I'm going to bet against it. I'm going to let it ride up until I start seeing it fizzle out on a chart. And then I'm going to go out a couple of months and do a put and bet against that thing. So when it comes down, that's when I'll make my money when it crashes. So here are some of the apps that you can download to kind of stay ahead of the news. I like Yahoo Finance. It's simple. I like Bazinga. I like Market Watch. They send you out, newsletters each day with kind of recaps of the market so you can see what's going on. You can also choose the stocks that you want to follow, and it gives you news that comes out about those stocks. So those are some cool apps to really have downloaded, or websites to have bookmarked to dig in and dive in a little more to this stuff.
But also, I want to also add, Chris, also keep in mind, buying the rumor and selling the news is definitely a rule of thumb manifesto that all traders are following in the stock market. So by the time you see the news, sometimes more, if you're not already in tune with it, if you don't have the apps and you're not watching the news, by the time you see the news, it's already been sold. And at that point, you're going to get late and then you're getting smacked because you didn't get in on time. So always keep that in mind when using the news as a catalyst to get in or out.
Yeah. And to add to that, a lot of times too, they say, hey, there's rumors of this company buying this company, and the company that's being purchased, their stock will start running up. Now, you want to catch it on the run up. You don't want to wait until the purchase actually happens, because once that happens, like Mike said, the news is already sold. So you want to just catch the run up, get your little profit out and get out. But I really want you guys these first 2 weeks, we're really focused on finding solid companies, 3 to 5 solid companies, or even just 2 solid companies or ETFs like we talked about, that give you the full market exposure to start adding to your long-term portfolio and just consistently investing in those, whatever you can afford monthly, so you can start growing that, getting that income from the dividends, getting that income from the natural growth of those stocks also. So another thing that I want to show you, this is one of my secret sites. So I'm going to show you guys this and share it with you. Let me get up out of here. Not that. Where is my site at? All right, this is one of my secret sites, Simply Wall Street. So that's simplywall.st. And everything that we just talked about, this site actually packages it up for you very neatly so you can digest it. So we talked about, I want to look at the company overview and see what they do. It's right here, all about the company, who they are, right? If I want to look at their valuation, it's going to show me that. This is my valuation. What this shows right here is this company is actually undervalued to its fair value based on analyst forecasts, because they expect this company to do even better than it's doing right now, right? So we want to say, okay, this is undervalued. Everything checks out. The price to earnings versus peers, the price to earnings versus industry, all of this stuff is very solid. So I'm gonna look at this company, right? If we want to look at future growth, it's going to give you information about future growth. Now, this right here concerns me. They expect, their future growth criteria is a 0 out of 6. This concerns me. The valuation sounded good, but now they're saying that they only expect it to grow a negative 3.3%. I'm out, right? What's Randy Jackson say? It's a no for me, dog, at that point. But then you can look at past performance. How has it performed over the past? Historical earnings growth, though, that's pretty strong too, 32.4%. But that year-over-year growth of negative 3.3% still concerns me. Let me dig a little more. The financial health of the company, and this is what it is. Look at all that debt. The debt to equity ratio is 102%, which means they have more debt than they have equity. That's scary for me. Dividend, doesn't pay a dividend. Y'all know me. If the company's not paying me to hold it and I can't get mailbox money when I'm asleep, I don't want to touch it. So this right here is one of my secret weapons when it comes to evaluating a stock. You could type in any stock here. You can add a watch list. You can build out your own portfolio here. You can read the markets of what's going on. But this, like I said, it puts it together real nicely for you so you can do quick research on companies that you may have interest in purchasing. Now, I know we started a little late, but we are at the hour here. We want to be mindful of everybody's time. If we have any questions, let's go ahead and get some questions out of the way before we wrap up. This was fundamental analysis in week 2. Next week is going to be technical analysis when we start looking at charts like the Japanese candlesticks. We're going to start looking at support, resistance, and trending, start talking about different type of stock patterns that you want to look for, and really dive into the technical side of it, because those two things merge together. That's for the people, like when you want to start learning about trading and day trading, those two things merge together are what make you a strong, profitable trader. So I'll pause there, see if there's any questions. All right. I'm gonna take silence as a no.
Thank you, Chris. It's a lot. As a novice, I'm attempting to digest this. I mean, you are familiar with me. I'm going to study this Simply Wall Street website and try to catch up. I feel as if maybe I missed something in week 1, and I'll be here for the deeper analysis in week 3. Great job, gentlemen. Thank you very much.
Appreciate you. All right, with that, we're going to go ahead and wrap. And
Homework. Let's give them some homework, Chris.
Yeah, let's give them some homework. Pick 2 to 3 stocks that you have interest in. Come to simplywall.street. Do some evaluation on those stocks. I'm going to choose a couple of people at random. So I'm expecting everybody to do this. I'm going to choose a couple of people at random. Give me the stocks that you thought about. I'm going to have you walk me through this and talk to high level. What are the top 3 or 4 things that made you say a stock was either a yes or a stock was either a no? And we're going to say if I agree with it or not. And then we're going to just hone that skill and what we should be looking for. Sound like a plan? All right.
Cool.
All right, cool. Everyone have a great night. See you guys back in week 3. Thank you.
Thank you.
Peace.